Morning, but thank you to everyone who's joined so far. And as usual, we'll probably get a few more people attend in the first few minutes. And before we get stuck into all the chat around inflation and how we navigate through that as business owners, I do want to mention the next webinar we've got coming up, which is in a few weeks from today, and it is all about the May 2023 federal budget, which will be delivered on the 9th of May, and we will be meeting at lunchtime on the 10th of May to run through what that means for small business owners, investors, and self-managed super funds. I expect this budget to be probably one of the most significant since the COVID measures were released in 2020 through the budget at the time. I'm anxious, but definitely keen to see what Labor has in store for us. Alrighty. Also, just as a bit of an introduction to Inspire, we're a Brisbane-based accounting firm based in the Fortitude Valley, and we're well known for saving our clients heaps of tax. And we're in the middle of tax planning season at the time, so I can see a couple of clients on now. You would be in the swing of things so far, I'm sure. We keep a tally of the tax savings we have for clients, and that is reaching, I'm sure it'll tick over to $24 million shortly, but quite a large amount of tax across the client base. If you are exploring Inspire or are keen to chat with one of our accounting team, whether you've got some questions or want to explore working with us, the best way to do that is to book a strategy call. And Tay, one of our team, has just posted that in the chat box if you do want to just suss us out or book one of those calls to have a chat. Just something I'll mention as well is in September 22, so last year, I published a book called Wealth for Life. You can grab a copy if you'd like. The topic or the focus of the book is running through 9 steps for business owners to create wealth for their family. So feel free to grab a copy if you would like that. And there is a first chapter for free thing if you do want to suss out what the gist of it is in that link as well. If you haven't met me, my name's Ben Walker. I started Inspire when I was 20. Oh, Phil, thank you. Phil just said, love the book, Ben. Really appreciate that. I started Inspire when I was 23 years old. And I'm an award-winning chartered accountant with actually it's a little bit more than 13 years, but a fair bit of experience working with small business owners. And I actually something to add to that is, even starting in a Big Four accounting firm, I've always worked in the small business area. So that was like the really tiny end of a Big Four accounting firm. But that's the sort of thing I've sort of stayed with, is small business owners throughout my whole career, which I love. And these are the important people to me. You've got Poppy, Ezra, and Rose, my kids, and my lovely wife, Stevie. So that's a bit of a personal intro. All righty, we've got a few more people who are online now. And I might sort of share the overview for the webinar. It's going to be a fair bit of content today. I'm just sort of looking back at the slides I've put together, and it is a sort of lot to get through. My intention is to break down these things in a really easy to understand way. And so what I do want to suggest is, if you do have questions, please use the chat box or the Q&A. I've got both of them open on my screen, so I'll keep half an eye on those. But what I want, the outcome for you, is to sort of realize what inflation can do to the financial performance of a business, and why it's actually not selfish or a bad thing to increase your prices, and almost that you have to. It is a factor or a reality of managing a business through this time. So I'm going to be sort of walking through right from the sort of, what is inflation, right through to the practical, how you might be able to deliver your price increases knowing that they're fair. So that's kind of what I'm going to be covering. sort of three things is on the screen here is why your profit might be slowly eroding, and you may not have noticed. That's interesting. The critical reasons why every business, or I'm pretty sure 99% of businesses should increase their prices. I don't know that many that the costs of doing business has actually come down, but I'd be interested to be proven wrong on that one. And then the practical steps you can take. So to actually sort of deliver that and work out how much you should charge. So they're kind of the three key areas that we will be covering. Alrighty. So what is inflation? The first dot point is I actually failed economics 101 at uni. It was one of the first subjects I did. I really don't love a lot of this sort of economics, supply demand. I kind of get the concept, but I'm not an economist. But I don't feel like inflation is a crazy difficult subject to grasp. So I've got some pretty basic examples that make sense to me. So what I found when I was looking for the proper definition of inflation is it's an increase in the general price level of goods and services in an economy. I'll get to examples shortly. When the general price levels rise, each unit of currency, so let's imagine each dollar, buys fewer goods and services. Consequently, inflation corresponds to a reduction in the purchasing price of money. So $100 today will buy you a lot less worth of stuff than $100, 20 years ago. That's the whole idea of inflation. And so I had a look at some examples of that. So I've got those things didn't come out quite well. The red writing over the top. So I've got examples of like bread, milk, sugar, butter, potatoes, and tea. It's interesting to see how this has increased over more than 100 years. Is this timeline here? But we've got and the other thing as well is I didn't know what D was after a number in currency, so I had to Google what does D mean, and it's pence. So some of you on the call might know all this stuff, but I had to sort of Google what that even meant. And P.S. thank you to whoever is shifting those things in the background. And the other thing is I needed to convert quarts to litres or pounds to grams, that sort of thing. So I hope I've normalised this a little bit for people who maybe were born around my time or after. So here's an example. So a loaf of bread back in 1980 cost 54 cents. And in 2020, the same loaf of bread, this is 500 grams. A loaf of bread, whatever that means in this example, is $3.06. I've seen bread cost more than that, but again, and this is 2020, so we're still 3 years behind in this table. Milk, so a quart, which converts to about a litre, in 1980 was 63 cents. 2 litres today, $2.60. Again, I think it's more than that. Again, because this is a few years outdated. So you kind of get the concept that things were a lot cheaper back then. But when you apply the idea of inflation, they weren't that cheap back then, because 63 cents would have felt like $2.60 today. I'll give another example where this is a little bit clearer. So things make sense to me when I'm comparing beers. And this is US stuff, not Australian. I couldn't find Australian beer stats, which surprises me. But the price of a beer back in 1952 in the US was 65 cents on average. Now, this column here that says adjusted for inflation, what that means is based on inflation since 1952, what would that cost in today's dollars? And it's interesting, that's $5.93. So what I did is this is a 10-year period, 1952 to 62. When I looked at what's happening recently, so the line is the gap in decades, the table I found goes up to 2016. So the price of a beer is $3.99. And of course, the adjusted for inflation, that was the date that this table was prepared. It's the same price. But when we look back, see how relative to what a dollar was worth back in 1952, beers have come down in relative price. Maybe it's cheaper to produce, or people can do it in bulk, whatever it is, versus back then. So I hope that it's not just, things weren't just cheaper back in the day. Here it was actually more expensive relative to $1 to get a beer in 1952. So again, we need to be mindful of that. Alrighty, so what does all this mean? I hope that sort of makes sense to I guess, an introduction to inflation in a basic way. But what I've got here is your cost of doing business, I'm almost certain, has increased. But if you haven't adjusted your prices, this is where your profit is going to reduce or turn into losses, and we absolutely don't want that at all. What's increased? Power and water has been astronomical. Wages, the Great Resignation, all this sort of stuff. There's been so much pressure on wages and people. Rent. I'm not too certain what's happened at a sort of larger scale on this. But again, it might be something that's gone up for you. Interest rates. Enough said. Exchange rates of overseas purchases, so that's fairly volatile, but again, may have gone up over the last couple of years. Subscriptions to stuff, like I see, Xero's just raised their prices a few months ago, and they did it about a year or two ago as well. Technology, similar sort of category. Construction has gone through the roof. I don't think that's news to many people. And raw materials, used in construction or any sort of raw material has also increased as well. So if your business uses any of this and you have not adjusted your prices, I am certain your profit has decreased, or at least your profit margin, the percent of every dollar of sales you make, has decreased. And now visually, I want to show you that. So I've done a couple of different graphs over the next few slides. On the bottom here, we've got time, so over time, and then the y-axis, I'm pretty sure this, the vertical one, is your portion of every sale. So this is in percents. It's not dollars, this graph. It's the percent of every dollar. So if you've got $1 of sales, in this example I give, 70% of that dollar is chewed up in expenses, 30% is leftover profit. And all things being equal, so inflation not changing or your prices not adjusting, your cost to deliver not adjusting, if that expense sits at a consistent 70% and your sales, your pricing doesn't change, then your margin, your profit margin, should stay at 30%. Cool. Let's go to what happens here. So let's see a price increase in your price of expenses increases by 20%. So the 70% here is now 84%. I hope that makes sense. So a 20% increase on 70% worth of expenses is 84%. And what that will mean to your profit margin is your profit margin has gone from 30% down to 14%. So 20% might sound considerable, but when you look at the compounding effect of inflation, so you look at what was inflation for 2020, 2021, 2022, it may actually be 10, 15, 20%. And it is also very different for different industries. Like I was looking at tourism in the December quarter on Australian Bureau of Statistics, it was something like 26%. It was huge. So again, this is not everyone, every business. I'm just using these numbers as examples. But the thing I want to stress is that a small increase in percentage of your costs going up can mean a massive percent of your profit gone. So if you were making 300 grand, when your costs were 70%, now they're 84, you're making 150K. You've basically taken half of your wage, your profit as a business owner disappearing. It's huge. All righty. The next concept. Actually, I want to sort of, I do want to show you what, I hope everyone likes my artistic skills, but what I've sort of noticed with builders and the building industry now, previous to this having a massive impact, most builders would offer a fixed price contract. The banks love that. There's certainty for the buyer. And before crazy inflation, the builders could kind of price their materials, and estimate the profit on a job. So let's imagine that the target net profit percentage for this builder was 20%. So if they charge $1 million, the goal is to make 200 grand off that build. Now, let's say they agree to a price, like a fixed price contract, where they budget in 80%, like they've always done. Let's imagine those numbers. They're going to make 20%, but what happens is as the job progresses, there might be, there might be 3 months before they pour the slab, and then they get started, and then prices steadily increase. That it wouldn't have to increase by much more than, let's say, 20-25% for then losses to occur for this business. And if they've got a fixed price contract where contractually they cannot increase their prices because their expenses have increased, then that builder is going to make losses. And we've seen a lot lately over the last few years in builders going broke. This is a major factor because the pricing was done at a time where they were going to make profit, but because time has passed, prices have gone up. Then a business cannot operate for very long on losses unless they're funded. So, this is sort of a fairly clear example to me why inflation can have a massive negative impact on a business. And so the other thing I do want to stress here is business owners cannot be complacent about the price they're charging right now. You can't think just because you adjusted your prices a year ago, that's going to be okay right now, or 3 or 4 years ago. We need to be reviewing this stuff, any more than a year, and it's dangerous. Anyway, I'll keep moving through these slides, but it is paramount the other alternative is risking, insolvent trading and making losses. All right, so what do we want? So I gave the example here of, if nothing changes in our price and our sales price and nothing changes in our cost to deliver, our profit margin will remain the same. So what we want is if costs go up, if inflation happens, but our price increases, we want the exact same percent margin, if that makes sense. So if we're making 30% margin in, pre-inflation, we want to be making 30% after that too. Or whatever your industry benchmark is as well. So, and again, I've got more content as we go on this stuff. But yeah, out of every $100, if you're making $30, it's the percent that counts. It's, you might need to charge $130 and you're making $35. But again, because of inflation, that $35 is now worth $30. It was worth $30 pre-inflation. I hope I'm not losing anyone here. It's, and again, I've done the graphs to sort of illustrate in a simple way what we would like. All right. So what I'm trying to say is if this is your business, so if your expenses are increasing, but your sale price has not changed, your profit margin is getting eroded, what we need to do is do this. So we need to adjust our sales price so that we still retain our 30% margin. And you want to do that as soon as possible so that you're not steering the ship where the profit margin is eroding to zero. So again, this is the outcome. If your business situation is to the left side, what to do about it is we must change our prices, or obviously adjust our expenses as well, which you can do. You can pull both levers to get your profitability better. All right. So what do you need to do about that? The first thing is actually assess the impact of inflation. And how that looks like is literally going into your accounting system, and working out what impact has, like you compare periods, whether it's quarters or years, to see what certain expenses have happened. The other thing is price adjustments haven't stopped. So what you do right now, we're in April, this exercise might need to be done in June as well, in September. Every quarter maybe is a good rhythm to review this. But again, the idea is that we're making that 30% or whatever your target net profit percentage. That's the important thing. The next one here is we need to adjust our prices accordingly. Now I've got some more notes on pricing and how we might do that, and things to be mindful of. But again, if that's your last lever, if you've negotiated all your pricing as best you can, then your last lever is pricing. And then the next one here is the other thing to do is also update your terms and conditions of business to include scope for inflation. So I know in the building industry, they've now got clauses and stuff to allow for increase in prices to their materials since signing that contract. There's an example of that. So things to consider is, when can you increase a price, and what method do you use to calculate that adjusted price? So these are good things to have. And again, this is not going to apply to all businesses. This is sort of like this suggests a recurring client in a sense. But if you're a business that sort of sells one thing to someone every few months or every few years, you might not have to go to that terms and conditions length. This is sort of ongoing relationship sort of stuff with clients, or long-term contracts as well. So if you've got 6-month contracts with bigger businesses or things like that, that would also be relevant. So there's one of my favourite movies. But the accountant. But how much do you increase your how much do you increase your prices by? I don't know for you, but here's what I'd consider. So the first one is industry profitability benchmarks. We actually subscribe to a service where we can see pretty much any industry's benchmarks for all sorts of things, profitability, wage costs, rent, that sort of thing. There's publications where you can find that stuff. It's usually sort of paid. The stuff you pay for will be way better quality. But also make sure it's really relevant to you. So I see like IBIS World, they look at if I looked at IBIS World accounting, it would include big four accounting firms, which is kind of irrelevant to me. So just make sure whatever you're using is very relevant. Again, what we have access to is we can even pick a revenue range. So an industry category and a revenue range and a date range of businesses that have been where the benchmarks have been caught for. The other thing is industry-specific inflationary pressures. So again, if your business uses a lot of power, I think I remember 18% was the increase in the last 12 months for power. If that's a big cost to you, you might need to put up your price or consider that more than a business who doesn't use so much. Also, wages in different industries will have changed in different ways. And again, when you look up in the Australian Bureau of Statistics, you can look up industry level CPI or inflation impact, and it will actually show you the differences in what's happening in different industries. I've already mentioned wages. Commerciality, so that's also something to consider. So even if you increase your prices up, can you still make money? Obviously, that's a really big consideration. And then will you still have clients if you put your prices up? Now, I've got an asterisk there because I think the fear of losing clients through a price increase is probably greater in most cases than the outcome of what will actually happen if you do that. So what I'm saying is you might think you might lose half your clients, but it's probably going to be way less. Again, that doesn't excuse recklessness when it comes to how we deliver that pricing news or how we calculate what pricing we should charge. But again, I think as a business owner or as a salesperson delivering that, I do think we're going to fear that loss more than what will actually occur. Other things to consider is, when was the last price increase? And what I mean by this is, if we look at compounding effects of inflation, you may need to add a huge increase in price. For instance, if you haven't changed your prices in 10 years and you look at what 10 years of CPI looks like, so $100 10 years ago, I don't know what the answer is, but let's say it's $160 today. That's a 60% increase for, if you just align it to CPI since your last increase. That's huge. And then the other one is, has the scope changed with the client since you agreed on the price, but so has the scope changed, but the price remained the same? And in services businesses, we call that scope creep. Anyway, that's something else to consider as well. So how do you actually price? Now, I've kind of got two basic examples here, one for services businesses, and on the next slide, we'll talk about product or manufacturing businesses. And again, this is at a high level. There'll be lectures you can find on pricing concepts that go for hours. But again, this is at a very high level. But services business or labor for trade. So if you've got, let's say you've got Sparkies and you pay them, how much should you charge them out at? This is what this idea answers. So the target hourly rate. So I've actually built a calculator. It's based on the rule of three. Now, what the rule of three is basically, if you pay someone 100 grand, you want them to produce 300 grand or 3 times their wages in revenue. And so that's the idea. How I've done that is done this calculator where, here's an example of different levels. We've got, like I've done an accounting for senior accountant, junior accountant manager. So we've put their salaries in, their working weeks, hours each week, the percent we would expect them to work for a client and sort of be working on a client, which means the average charged hours a year. Some service businesses write off time. So there's a line for that if you need that. So the hours actually billed net of write-offs is that next line. And then the rule of thumb, this says 3.5, but again, the rule of three, I would have at least three times the salary. And then this works out how much the target chargeable rate per hour should be for you. So again, you can use this screenshot, or if you do want a copy of this calculator, it's a Google Sheet. Please just email me. You should have my email from the registration email you got for the webinar. Just reply to that and say, can I please have the hourly rate calculator? And we will get that to you. Alrighty. But yeah, so it'll give you that clarity on, again, according to the rule of three, what you should be charging per hour. Now, the rule of three, what that suggests is, of every $100, a third of it should be going to the salary of this person, let's say. A third of it should be going to admin, overheads, marketing to keep the business running, and a third of it should go to profit. That's kind of the high level rough rule of three. Again, this is very much so aimed at services businesses. So lawyers, engineers, IT consultants, and even the labor portion of a business that sells labor and product or parts. Cool. Now, manufacturing or if you're selling goods. So a really basic example of pricing here is, what is your cost for that product? What's your target markup percentage? And that will give your price. Now, in terms of your target markup percentage, the risk is we need to make sure we're accounting for admin and overheads here. So, if it costs you $1 million to run your office and your power and your bits and pieces, you need to make sure this markup at least covers that $1 million first, for the amount of goods or things you can sell. For instance, if our costs is 500 grand and our sale price is $1 million, the margin on the product would be in dollars $500,000. But if it costs us another $1 million on top of that to run the factory, we've made a 500 grand loss. So we need to make sure when we're doing this markup percentage calculation, we are accounting for your overheads, your sort of fixed costs to a degree. I don't think any costs are fixed at the moment, but yeah, we need to make sure that we don't just consider the cost to produce the good, but it's to provide the business system that that's there to sell it. Cool. Thanks, Phil. I've seen your Q&A there. But yeah, any questions that come through, just pop them there. And I've actually got Q&A coming up very shortly. Cool. The other thing I kind of want to encourage people who are hesitant to do this. Again, if you're hesitant, let's say you don't do this. What I don't want, and I'll find that slide again. I don't want you to be this. I don't want you to end up making a loss. And to be honest, I don't even want people taking hits like this where they halve their profit percentage. So we have no choice but to do this as business owners. Well, we do have a choice at the end of the day, but if you want your business to survive, we do not have a choice but to make sure we are charging appropriately. And I also want to illustrate that losing clients could actually be quite profitable for you. Not losing them all, but losing the ones that should go. And how I want to show this is, let's say this line here is $1 million in revenue. Let's say someone has 100 clients and the average spend per client is 10 grand. That adds up to $1 million. If we increase our client spend our average client fee by 20%, let's say that's the number, and we lose 10% of our client base because of that, we're down to 90 clients and 12 grand average spend. So the revenue has actually gone up of the whole business to 1,080 grand. So we've increased the dollars, but our cost to deliver has gone down if it's proportionate. And if we think about it, or let's say you're in a service business and you haven't had to fire any team, they will have more capacity to deliver to new clients. Alrighty. Cool. So at the end of the day, I do want to encourage you that, yes, losing clients through this process may be an outcome, but I just don't feel it's the end of the world. And it's probably even going to be, it should be better for you if you go about it the right way. There's the asterisk. Alrighty. Delivering the news, just some suggestions I've got. I think it's going to be different for different businesses, and also the amount of the increase. But if you're business to business, I would suggest one-to-one meetings. I've kind of guessed a level. If you're sort of more than 2.5 grand per client, I would probably have do it as a part of a one-to-one catch-up, a phone call, a Zoom meeting, whatever it is. Also, you need to put in lots of work on making sure the price is fair. So it's fair for you and fair for the client. They're still getting value. The other thing is mindset is super important. So making sure, we're reinforcing this whole purpose of fair mindset. And again, I've tried to explain the logical reasons why this is a must for pretty much every business. So please, there's options to do mindset work around this. We've got some great people who help us with this and sort of deal with any sort of emotional blocks that we might have around it. But again, mindset is extremely important. The other thing is people are expecting adjustments. I've seen this where, clients are budgeting for the coming financial year. They're already expecting adjustments or increases to prices on a lot of their costs. I don't feel like it's going to be a surprise if you do have a conversation with a client on this. Also, B2C, I think there's sort of less emotional stuff around this because the consumer is probably not going to be spending thousands. It might be, depending on your business. But, take a GP thing, for example. I've seen this in a doctor's surgery where, hey, our prices are going from X to X from the following month. Just a heads up. It's usually a few bucks here and there. And they sort of have that as a flyer on their desk. Or, you you go to Woolies, prices for food is seasonal. It's, it is always adjusting. So I think B2C, just change what it's advertised for. And unless you've got sort of high value or high average spend, in the thousands, I don't think there's going to be too much stuff versus a B2B relationship where you've got thousands or tens of thousands that clients are spending with you or more. Alrighty, and a couple of final things to consider. Reflect on the value to the client. Again, where is my, here we go. It's in the next point here. Ensure it's a fair exchange of value. As the business owner, if you are a business owner on the call, you are probably the worst judge of your own value. You will probably play it down because you're so close to the expertise that you have that a third party would actually see you more valuable than you are. You feel you are. So again, I want to encourage you that most business owners will probably not put their prices up enough because of these first 2 points here. The other thing is, in your discussions with clients, I feel it's really good to prepare by having a list of generic reasons and specific reasons that their price is going up. So things to do here is research what your industry has done with inflation, and also the costs, the major costs to deliver to your clients. Like what's gone up? Has wages increased? Like I know accounting salaries in 2022, the calendar year alone, increased by 11%. That's just in a calendar year. Research your industry wage increases, I mentioned that. These should be logical reasons. So what I mean by this list of generic and specific reasons should be logical reasons that support your price increase being fair. And then the other thing is really being okay with a client leaving. If you've done everything you can to make sure the price is fair, you've spent time communicating the reasons why that is the case. If they want to think about it, great. But if they want to leave, also great, because we don't want to be delivering work to clients unprofitably. We don't want to be in that red section that I showed beforehand. And no client. So having a client leave or no client is better than having an unprofitable client. They're going to chew up capacity, time, and resources, and they're better off not being a client of yours. The other thing, last one here, is mates rates is not being a mate. So again, there's a bit of an expectation that, generally that, you might know someone, they'll look after you. What I want to change that frame of mind is our mates we need to be fair with, if that makes sense. So again, if all your pricing is fair, you're providing value to even a mate. If they're expecting a discount because of that, being a friend with you, I just don't think that's looking after them or yourself. That's not serving either of you. So just the sort of final thing there. Cheers, Steve. All righty. Cool. Well, that brings the content I've got to share to an end. Again, if you do want to talk more even about this sort of stuff, the industry benchmarks that we have access to or anything like that, please book a strategy call with one of our accounting team. The link just went in the chat box there. And don't forget, if you joined a bit late, I shared the next webinar we've got coming up, which is the May 2023 federal budget debrief. That's on the 10th of May at lunchtime, the day after the budget gets announced at night. So please register for that if it is of interest. And that brings to the end of the formal content and open for Q&A. I've only seen one question so far, so please pop in the chat box or the Q&A any questions that you have. Alrighty, so Phil, we are looking to add a fuel surcharge to add to the job invoices, as this is one of our main costs for our mobile service vans. This is partly to help explain the clients the extra cost because they are aware of fuel increases. Is there a better way or another way to do it? So I'd expect your price to increase because of fuel, if that's a major cost. But again, it's all the other stuff as well. So what I would do is suggest that you may include a fuel surcharge separately, but also your main, like your call out fee or your first hour fee, whatever, however you sort of charge that, you also increase that too. And again, having some insight to your business, I wouldn't expect, like if you do lots of once off work or once every couple of years work for a client, they're not going to sort of be thrown out by if you increase your prices by $50 per service. It's if you've got people using you every week, then that's again, I feel like it needs a conversation, just saying, hey, we needed to adjust because of these reasons. If that comes on so it comes across like a fuel surcharge, cool. But again, I think we need to adjust all the other inputs as well, which would reflect on your overall costs. I hope that helps. Alrighty, Steve, what are your thoughts on expectations from staff to increase their salaries as a result of inflation, especially when profit margin and turnover are currently much lower? That's a really good and challenging question, Steve. What I defer to personally is benchmark salaries, and that's based on experience or level or what they're providing for you, and there's salary surveys. Again, we need to make sure we're getting the right state that you're in, the right industry, to be really specific. And the other thing I've done in the past is actually get a recruiter to make sure our internal benchmarks are appropriate as well. So I'll actually do like a case study with a recruiter to say, hey, we've got this person who works here. They've had 3 years experience. They do this, this, and this. They've got their CA. What should they get in the market right now? And if that is different to what we want, and we've done this before, we've made a small adjustment because we have been, our previous scales have been under. The other thing to be mindful of is there is businesses paying premiums to poach people. And this is what I don't think is fair. So let's say, so the recruiter comes back, and let's imagine they say, cool, that person might be worth 65 to 75 grand right now. And on a good day, they might be 80 to 85K if there's a business willing to sort of pay that premium. Now, what's probably going to happen for the person if they change and get that 80 or 85K is they probably won't get a salary increase for a long time, versus depends on what your culture is. We set our salaries based on performance and hitting milestones. So we have our team usually having many smaller increases over time versus sort of big jumps. So again, like what I'd be mindful of, and if one of your team is considering, an extra 10 grand more over there, I'd say, well, okay, cool. Well, what would a 10 grand more look like at your business? How soon? And then what about more than that? Like, is there when's the next 5 or 10 grand bump going to happen? So I think, it's not an easy conversation. It's also very reliant on your team being mature about it as well. And not just there's a derogatory term for it, but trying to find the highest bidder on every day, and moving jobs 3 times in a year just to get an extra 5-10 grand each time. That's going to catch up with them. And the other thing as well is if they go and sell this big story to another employer, the expectations of the new employer may be much higher than their ability to deliver. So again, it depends on the person, I feel, as well, and their own mindset. But again, if the overarching goal is win-win for the business and the team member, and it's fair, and you've got to leave the outcome out. Same with repricing clients. If it's fair, you put in the work, the intention is fair, and they leave, it is what it is. I hope that helps. And just part 2 of your question. Sorry, there was a part 2, especially when profit margin and turnover are currently much lower. Mm-hmm. Yeah, that may need a bit more thought around making sure you've got the right team for your revenue. So what I would consider there is your reduction in revenue temporary? Like, will it pick up later? If then you want to make sure you retain capacity for the later. But then if that's not going to happen, then I would look at, what's the word? Not resigning. Redundancies, genuine redundancies, because you don't have the ability to profitably pay them. Alrighty. Okay, Phil. Every week is real estate. So, okay, yeah. So you've got a real estate client where you do every week. So yeah, I would do a letter and adjustment and a conversation for sure. Just saying, hey, we've had to do this, but and again, if they haven't changed for a long time, you must have that conversation, and again, put in the work beforehand to make sure it's fair, and let go of the outcome. Alrighty.